Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 23rd of August 2020. And yesterday we published our Gold and Silver Weekly Update for the week ending the 21st of August, where we pointed out that both gold and silver have, at least for the moment, come off their highs and are arguably operating within a region of consolidation. And we've placed a link to this video in the description box below just in case you haven't had an opportunity to listen to it so far. Now today we thought we would discuss a very useful article published by Bloomberg highlighting that the recent price rises in both gold and silver have effectively been the result of ETF demand. It also suggests, but without saying so, but by implication, that some of the physical shortages experienced in recent months have partly been caused by the necessity of these ETFs to hold the physical within their own vaults, or at least the vaults of the custodians of it. What is also a possibility is the explanation they give for how it is that the likes of JP Morgan hold such high levels of silver, and could be an answer not quite as sinister as some have suggested elsewhere. Though, of course, none of us really know the answer for sure. Such is the shroud of secrecy around such holdings and banking in general. Further, it's also worth bearing in mind that those who, each day back a couple of years ago, were stating that gold and silver prices were suppressed by crooked banksters and frightened governments have, for the moment at least, all but disappeared, now that the precious metal prices have risen again, with gold reaching multiple all-time highs. It truly amazes us that when prices go down, it's manipulation and corruption, but when they go up, silence. Was it really manipulation, or just simply the profound effect the traders involved with GLD and SLV markets have on the price, and those paper trades with such high levels of gearing? After all, why has it suddenly become acceptable to accept such high prices now and not 2 years ago or 3 years ago the prices then? One can draw one's own conclusions, and we're not going to commit either way for the time being, as this in itself is a debate on its own. The basis of this article, though, is that the ETF and the purchasing of ETFs have been the main driver of precious metal price rises. And as we alluded to in yesterday's video, the man in the street is either a late participant, as always, or a bystander, as he no longer really has the wealth to invest, simply because of COVID-19 and the effect, devastating effect, it has had, particularly on the American economy. And of course, we're not including you, our loyal subscribers, of course, as we know that you are resilient in your purchases, certainly of silver and for a number of gold. So let's take a look at that Bloomberg article. Bloomberg article dated August 23rd, 2020. Headline: Gold fever in 2020 means exchange-traded funds. In the 19th century California gold rush, the surest way to a fortune, according to Mark Twain, was to be in the pick and shovel business. If 2020 gold fever has an equivalent, it's the ETF business. Exchange-traded funds backed by physical gold and silver accumulated more than $50 billion of bullion this year. ETFs now hold more gold than every central bank, with the exception of the Federal Reserve. That's generated windfall fees for ETFs and has been a boon for everyone involved in the business of servicing those enormous hoards of shiny metal. That includes the financial firms that provide the funds to investors, through to the banks and security firms responsible for storing hundreds of billions of dollars worth of gold and silver beneath the streets of London. This is a picture of the gold bullion in the vaults at the Bank of England. I know that some of our listeners might have their silver hoard in similar quantities. At these times, it's a very good business to be in, said George Milling Stanley, Chief Gold Strategist at State Street Global Advisors, the marketing agent for the largest gold ETF, SPDR Gold Shares, or GLD. There's no question in my mind that ETF demand is driving gold right now. ETFs typically charge fees as a percentage of the value of their assets. With investors adding to their holdings as spot gold soared to a record above $2,075 an ounce this month, earnings have benefited from a double boost. Total fees for the top 10 gold ETFs, based on current prices and holdings, are about $610 million a year, according to a Bloomberg News calculation. While for the top 5 silver ETFs, the figure is around $110 million. Investors have bought more silver through ETFs in the first 8 months of the year than was produced by the world's 10 largest miners combined last year. GLD is delivering some $300 million of fees a year at current holdings and prices. That's good news for State Street and also for the World Gold Council, a mining industry-backed group that helped create the ETF, as both take a cut of those fees. It has also benefited the few big banks, principally JP Morgan Chase & Co. and HSBC Holdings plc, that hold gold and silver on behalf of the ETFs in underground vaults behind foot-thick reinforced doors. Those suspicious of JP Morgan buying the gold and silver for themselves and stacking it, depressing the price, with a view to then releasing it into the marketplace. Could this be an alternative rationale or explanation? For them, it's a niche business, but as holdings have surged in value, it has become a solid earner. GLD's gold is held in HSBC's vault in London. The last time the vaulting fees were disclosed in 2015, they amounted to 10 basis points or 0.1% per year for the first 4.5 million ounces held, followed by 6 basis points thereafter. HSBC declined to comment. Vaulting typically accounts for roughly 10% of the $1.1 billion to $1.2 billion a year that banks earn from precious metals, according to Amrit Shahani, Research Director at Coalition Development Limited. But he said that figure will be pretty much double this year. The surge in demand has strained the system. GLD's quarterly reports reveal that beginning in April, it owned some gold that was not held at HSBC's vault, but instead at the Bank of England, which trails only the Fed in its store of bullion. As movements of gold were slowed down by social distancing during the coronavirus pandemic, the Bank of England couldn't transport the metal quickly enough to HSBC's own London vault to meet the ETF's demand, according to people familiar with the situation. The record pace of silver buying by ETFs is causing other headaches. Bulkier and less valuable than gold, it takes up large amounts of space in a vault. The custodian for the largest silver ETF, the iShares Silver Trust or SLV, is JP Morgan. For a long time, the fund's prospectus included a note explaining that if its holdings increased above 500 million ounces, it would seek an additional custodian. But in July, as the SLV's holdings soared above that level, the clause was quietly dropped. JP Morgan has done several deals with other vault providers in London and is now storing silver on behalf of the ETF with Malka Amit, which has a vault close to Heathrow Airport as well as 2 vaults owned by Brinks Co., according to the ETF's daily bar lists. A spokeswoman for BlackRock Inc., which owns iShares, declined to comment. Still, bankers and logistics providers say there's still vault space available in London following an expansion during the last gold bull market. That includes room in HSBC's vault, according to Milling Stanley of State Street Global Advisors. "We're a corner of HSBC's vault with GLD," he said. "Even with the growth surge in the gold-backed ETF. The vault is enormous, no question about that. We have space in that vault." End of article. Interesting, don't you think? It's nice to see the Bank of England vault picture. Of course, some will argue that each bar is filled with a metal, not gold, and others will argue there is no gold in Fort Knox or elsewhere in the United States. Now, we do not necessarily agree with those conspiracies, but they are fascinating enough questions to deal with and discuss. For us, after a number of years on this channel, it is slightly amusing to see that the main driver of precious metal prices are those dealing primarily in the markets where the majority of those investors have no intentions of taking delivery of the physical metal. The very same mechanism that these organizations were accused of using to depress prices previously. Now, that's not to say there hasn't been some degree of manipulation. As we all know, there has been. But perhaps not for the multitude of nefarious purposes that have, in the past, been proffered. Otherwise, those very same people will have to answer today why, with the dollar under threat and gold being the one place people should be flocking to, why are the suppressors not actively engaged now, as there's no evidence of it, when they were, when no one was really that interested in buying gold and silver a few years ago? What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.